Welcome to the chapter on financing decisions. This chapter will help you understand the crucial aspects of raising capital for business growth and operations. In this chapter, we will discuss equity financing, debt financing, and the cost of capital. These are essential concepts for making informed financial decisions in any business. Equity financing involves raising capital by selling shares of the company. This method does not require repayment or incur interest, but it does dilute the ownership and control of the original owners. Key concepts in equity financing include shares, which are units of ownership in a company. An initial public offering, or IPO, is the first time a company sells shares to the public. Private placement refers to selling shares to a select group of investors rather than the public. Imagine a startup company needs $1 million to expand its operations. The company decides to raise this capital by issuing 100,000 shares at $10 each. By doing so, the company raises the required funds without incurring debt. However, the original owners now own a smaller percentage of the company. Debt financing involves borrowing money that must be repaid over time, typically with interest. This can be done through loans, bonds, or other financial instruments. Unlike equity financing, debt financing does not dilute ownership but requires regular interest payments and eventual repayment of the principal. Key concepts in debt financing include loans, which are borrowed money from a bank or financial institution that must be repaid with interest. Bonds are debt securities issued by a company to investors, promising to pay back the principal along with interest. Interest is the cost of borrowing money, usually expressed as a percentage of the principal. Consider a company that needs $500,000 to purchase new equipment. The company takes out a loan with a 5% annual interest rate to be repaid over 5 years. The annual interest payment can be calculated using the formula. The interest payment formula is given by the principal amount multiplied by the interest rate. For the first year, the interest payment would be $500,000 multiplied by 0.05, which equals $25,000. The cost of capital is the cost of obtaining funds, either through equity or debt. It represents the return that investors expect for providing capital to the company. The cost of capital is crucial for making investment decisions and evaluating the feasibility of projects. Key concepts in the cost of capital include the weighted average cost of capital, or WACC. WACC is the average rate of return a company is expected to pay its security holders to finance its assets. It is calculated as a weighted average of the cost of equity and the cost of debt. The formula for WACC is given by the sum of two components. The first component is the market value of equity divided by the total market value of the company's financing, multiplied by the cost of equity. The second component is the market value of debt divided by the total market value of the company's financing, multiplied by the cost of debt and adjusted for the corporate tax rate. Suppose a company has the following financial structure. The market value of equity is $2 million. The market value of debt is $1 million. The cost of equity is 8%. The cost of debt is 5%, and the corporate tax rate is 30%. The WACC can be calculated as follows. First, calculate the total market value of the company's financing, which is the sum of the market value of equity and the market value of debt, equaling $3 million. Next, apply the WACC formula. The first component is 2 million divided by 3 million, multiplied by 0.08, which equals 0.0533. The second component is 1 million divided by 3 million, multiplied by 0.05, and then multiplied by 1 minus 0.3, which equals 0.0117. Adding these two components together gives a WACC of 0.065, or 6.5%. Understanding financing decisions is essential for any business. Equity financing and debt financing are two primary ways to raise capital, each with its own advantages and disadvantages. The cost of capital, particularly the WACC, is a critical metric for evaluating investment opportunities and making informed financial decisions.